Well, certainly, if that 25% probability of recession comes to pass, the 5,600 target will prove to be too high. But again, that's not the base case. I think the base case view of the world and the view that is supported by the recent data is that the economy continues to grow. As we just saw during the second quarter earnings season, S&P 500 earnings are continuing to grow and, in fact, continuing to accelerate. And on top of that, as we were just discussing, we have the Fed cutting. So I think when we look at the whole range of the macro backdrop, the base case should be higher equity prices at year end.
But the problem I have with earnings season, Ben, and I agree with you, but when you look at the guidance, when you look at the commentary, especially about the macro situation, a lot of companies are saying that we could be entering into peak margins in the current cycle. There was a lot of commentary about and questioning about the health of the consumer, pricing power. How then does that colour how we allocate towards the retailers, banks and financials, and consumer discretionary?
I think you're right. Although the earnings backdrop is still healthy, although the economy is still healthy, for the last couple years, we've really been dealing with an accelerating environment. And in our view, we're now dealing with a deceleration. Not deceleration into recession, not deceleration into a market downturn, but that is a big change for asset prices. And as a result, even though we're pretty confident in the trajectory of the overall market, we are recommending to investors that they continue to rotate away from some of the most cyclical industries, like you just mentioned, that until this point have been some of the strongest performers this year.
Can you help us understand why you still prefer growth over value when we have the regulatory overhang on mega-cap tech, you have the market questioning the entire AI narrative and the capital spending, and who or who is not really monetizing the AI theme? Just walk us through why you still prefer growth over value.
Here, I think it's important to combine both the top-down macroeconomic framework and a bottom-up appreciation of those company fundamentals you were just alluding to. So from a top-down perspective, an environment of slowing economic growth, still healthy but slowing economic growth, and falling interest rates has historically supported growth stocks over value stocks. Value stocks tend to be more cyclical. They tend to do better when the economy is accelerating. On the other hand, there is clearly a risk to some of these extremely large stocks, both from positioning, as we've seen in the last couple of weeks, as well as from the concern that their very strong rates of growth are no longer accelerating. And in fact, due to concerns about the return on investment of AI capital, perhaps are even overestimated by market pricing or analyst estimates. So our solution is to prefer growth over value, but adopt a more diversified approach to growth. So instead of owning just those handful of tech stocks, which have been fantastic investments over the last few years, perhaps diversifying into a broader selection of tech stocks, also perhaps some healthcare stocks, maybe even some growth stocks in Europe as well, to help spread out and reduce that concentration risk.
But if you did want to, for the sake of diversification, get some small caps, which particular sectors do you think look ripe for the picking?
You're right. Russell 2000, of course, has thousands of companies in it. Some of them are going to be really great opportunities. I would be focusing on the less cyclical parts of that market. So there's a large number of tech companies in the small cap index. There's a large number of healthcare companies, even some utilities in the small cap index. I think those would be better opportunities than some of the more cyclical parts.